Hello everyone, welcome to TradeSmart. On this channel we are going to be testing different day trading strategies and improve them for better results. The aim is to create objective, non-emotional strategies which later can be programmed into the trading bot. The main idea to this channel is from another channel called TradePro. If you want to check that out, links in the description, I suggest you do. If you like this type of content, hit the like button, subscribe and comment down below what strategies should I test next. And now, let's not waste any time, let's get into the strategy. Okay, so this strategy is the 200 EMA MACD pullback strategy. You will need three indicators. The first one is the 200 EMA, the second one is the MACD, and the third one is the ATR or average true range. You can find all of that on TradingView. You just type in average true range. It will be this one, MACD, this one, and you're going to search for exponential moving average, and it will be this one. They are all built-in. So the rules of this strategy are very simple. Let's go and look at for a long position. You need the price to be above the 200 EMA. You need a pullback from the MACD below the zero line. It happened right here. And we wait for the next cross up. So this is on this candle. That will be a long position. Let's just put it in a long. You are targeting a 2-to-1 risk to reward ratio. The risk is going to be 2 times ATR. So the ATR value here is 85. You just multiply that by 2. It's going to be 170. Click OK and target 2 times the risk. That's all. This is a winning trade. Let's look at another example. We have MACD above the price, above the zero line, sorry. It crosses back down under the zero line. We have a cross up. The price is still above the 200 EMA. So it will be a long position again. Target 2 times ATR for the risk, which is 2 times 75. It's going to be 150. Click OK and target 2 times the risk. As you can see, it's another winning trade. Now let's look at a short example. You have the price going below the 200 EMA. You can see MACD is crossing above the zero line and made a cross back down on this candle. So that's a short position. 2 times ATR will be 2 times 74, which is going to be 162. Oh no, sorry, which is 148, yeah. Click OK, target 2 times the risk. As you can see, it's a losing trade. Now, very simple strategy. Let's get into the 100 trades. Okay, so the results are in. After 100 trades on the 30-minute time frame with a risk to reward 2 to 1, we gained around 8% on the account, which is not too bad, not too good. We won 35 times and lost 65 times. The max losses in a row was 9 and the max wins in a row was 4. The time took to complete all the 100 trades was 225 days and 12 hours. So, possible strategy improvement. So I noticed when there's too much volatility, it tends to hit the stop loss more frequently. So when you see price going up and down a lot, just don't take the trade. The second improvement could be when there's a lot of 200 EMA crosses. So the price just crosses the 200 EMA within like 20 candles. You just don't take the trade because it means that the market is indecisive and you don't know where the price will go. The third one, if you see price moves too far from the 200 EMA, you just don't want to enter because it doesn't matter if there's the good entries, it's just too risky. The fourth one, if you get too frequent trade signals, I would say 2 within 20 bars, you don't want to enter because it means the market is choppy and didn't decide where it wants to go. Okay, so to decide if there would be better results with different risk-to-reward ratios or on different time frames, I'm going to be doing 8 more 100 tests. We are going to be testing the 1-to-1 risk-to-reward, the 3-to-1 risk-to-reward, when we are going to be testing it on the 15-minute time frame and the 5-minute time frame. Let's start with the 1-to-1 risk-to-reward ratio on the 30-minute time frame. Let's go. Finally, the results are in. After 900 trades, we can see that the best performing time frame and risk to reward was the 15-minute 1-to-1. Let's go over them one by one. So on the 5-minute time frame, you get the best results with the 2-to-1 risk to reward ratio and the worst results with the 3-to-1 risk to reward ratio. As you can see, on the 15-minute time frame, we get the worst results and the best results also. We get the worst results with the 3-to-1 risk to reward ratio and the best with the 1-to-1. On the 30-minute time frame, which was our original test, we get the best results with the 2-to-1 risk to reward ratio, which we tested first. So what can we learn from this Excel sheet? If you check out, I put out 4 different columns with the best risk to reward, the worst risk to reward, the best results and the worst results. So if you check out the best risk to reward ratios, you can see that 2 out of the 3 is the 2-to-1 risk to reward. So I would suggest sticking to the 2-to-1 risk to reward ratio, as we originally started with. The worst risk to reward ratios were a 3-to-1 in all of the 3 cases. So I would suggest not taking the risk and going with the 3-to-1 risk to reward ratio. Would I recommend using this strategy for live trading? Not really. It needs improvements. If you take your time, I am sure you can make this profitable, but with 5 to 10% gain on the account, the fees would eat a significant portion of your profits. Some strategy improvement tips. Try implementing the stochastic RSI and the 50 or 20 EMA. That pretty much sums up this video. Thank you for watching. Don't forget to like, subscribe, hit the notification bell and drop a comment about what strategy should I test next. Until the next video, have a great time.